Global markets have seen a significant decline in the last weeks as President Trump's back and forth and the eventual announcement on April 3rd of global tariffs rattled stocks. This led to the worst single trading day since 2020. These tariffs, currently set at a baseline of 10%, include almost every import and can reach up to 34% with key trade partners like China, 20% on the European Union, and even 25% on South Korea. Investors are now looking for robust equities that can weather the storm as retaliatory actions are imminent and economists warn of potential recessions and economic uncertainties. I believe that these four stocks can be an awesome opportunity right now in this uncertain situation. First pick, Euronext. Euronext is a European stock exchange that is operating in Amsterdam, Brussels, Dublin, Lisbon, Milan, Oslo, and Paris. Through trading stocks, bonds, derivatives, as well as Forex, it is a key player in the financial infrastructure of Europe. The stock has already seen a significant run-up as investors seek for exposure outside of supply chain heavy industries. Europe is currently a safe harbor for investors as the company is experiencing increased volumes through a shift of investments from the US to Europe. With the recent increase in stock price, a lot of this increased volume seems to be already priced in. If we, however, look at the discounted cash flow analysis, there still could be room for growth. With assuming 8% top-line growth, the company is currently trading in the fair value range. Considering that 8% per year seems rather conservative compared to historical rates, and that the tariff environment should fuel growth further, the company seems to be undervalued right now. Second pick, 3i Group. 3i Group is a London-based private equity company. Their main holding action, a European discounter, could be a suitable pick to navigate the uncertainties right now. Trump's tariffs created a challenging environment for companies that are reliant on global supply chains, favoring companies with local operations and a domestic customer base. Action is currently operating 3,000 stores across 12 European countries, therefore mostly avoiding exposure to US tariffs. Their business model as a discount retailer also tends to perform well in times of economic uncertainty, as customers look for low-cost alternatives. Action has been able to grow significantly in recent years, realizing growth rates of 29% per year. They are on track to continue this growth, anticipating like-for-like growth in the high single-digit range and 370 new stores in 2025. Assuming a realistic top-line growth rate of 20% per annum, Action alone is currently justifying 3i's valuation. With these assumptions, the company seems to even be undervalued by 11%, making it a solid pick in these uncertain times. Third pick, Amazon. Some of you might wonder how Amazon made it on this list, as Amazon faces significant challenges in this tariff environment. I nevertheless believe that it can be a good pick, as this situation also offers opportunities for the company. Amazon should be able to utilize its superior logistics network and diverse product offerings to at least position itself better than fellow competitors like Walmart and Target. Trump banning the minimus loophole should also help Amazon battle the ultra-low-cost competitors like Shein and Temu. Through Amazon's great diversification and their vast business segments, the company could stomach a reduced margin in their e-commerce segments to extend their lead in their already dominant market position, especially considering that AWS, as of now, isn't impacted by any tariffs. The company should be able to explore alternative sourcing strategies through countries with lower tariffs, also leading to an advantage compared to smaller competitors. Given the drastic decline in the last months, the company seems to be offering upside potential. I conducted 2 discounted cash flow analyses for the company, factoring in the bear and bull case scenario. Bear case. Even in the bear case scenario, so with assuming below market growth rates and profitability in each of Amazon's segments, the company is currently trading at the fair value range of approximately $1.9 trillion. Bull case. With anticipating growth rates and EBIT margins in the range of the underlying markets of each of Amazon's segments, the company is currently undervalued by 101%. This, paired with the above-stated opportunities, make Amazon a phenomenal pick right now. Fourth pick, Google. Google's exposure to the tariffs is primarily indirect, as their main business is solely online-based. An economic slowdown caused by Trump could nevertheless negatively impact Google's advertising business, as customers might reduce or even cut their spending in this segment. Some analysts even expect Google's revenue in the services segment to decline by 5% due to the declining demand caused by the accompanied economic slowdown. The company is also reliant on data centers to expand their cloud and AI initiatives, which requires importing state-of-the-art hardware. Tariffs on these components could therefore increase Google's costs in this segment. These two aspects, however, are the two main concerns I have with Google in the tariffs environment. The market seems to be less optimistic, as the stock has experienced a year-to-date decline of 22%. Is this justified? I don't think so. When we look at my latest valuation on Google, it becomes pretty obvious why I think so. Bear case, no services growth. Even in the bear case scenario, with assuming zero growth in the services segment for the next 8 years, the company is currently slightly undervalued, with a fair value share price of $156. Bull case, regular growth. When we now, however, assume a realistic growth rate of 12% in the services segment, Google looks to be undervalued by up to 67%. This valuation situation, as well as the fact that Google is only indirectly impacted by Trump's tariffs, make Google a suitable pick in these uncertain times. What are your thoughts on the current situation? What are you buying right now? Please let us know in the comments.